This is Al Brooks. Thank you for watching the Brooks Trading course. This is the first of 3 videos on the market cycle. I'll begin by talking about the 4 parts of the market cycle. Next, I'll talk about how a breakout transitions into a channel, and the transition begins with a pullback. And finally, I'll talk about how a channel evolves into a trading range. Every bull chart is made up of one or more of these 4 patterns. And it doesn't matter on the time frame, doesn't matter on the type of market, doesn't matter on the type of chart. Every chart that's going up is made up of some combination of these 4 patterns. Sometimes the pattern might only be a bar or 2 long. Sometimes it may be 20 or more bars. For example, breakouts are often relatively brief, and trading ranges can last a very long time. I'm going to be talking about a strong breakout, very little overlap among the bars. You can see here, no pullbacks. And then a tight bull channel, which has pullbacks that are very brief, 1, 2 bars, 3 bars. And if you draw a channel, lines above and below, you can see that it's very tight. And a tight bull channel is a breakout like this on a higher time frame chart. So if this is what the 5-minute chart looks like, this is what the 15 or 60-minute chart looks like. Next, a broad bull channel. The market's making higher highs and higher lows, so it's a bull trend. But sometimes the pullbacks are so strong, the market becomes always in short. And traders can make money buying and selling. Even though it's a bull trend, they can make money buying and selling in a bull trend. And then finally, a trading range. The market is mostly sideways. Sometimes it has a new high. Sometimes the market goes above prior highs, below prior lows, but it's mostly sideways. It's a channel because you can draw lines below and above, but it's a sideways channel. Sometimes a chart will have only one of these patterns. For example, sometimes you'll have a broad bull channel that will last hundreds of bars. Now, a breakout. What distinguishes a breakout from the other 3 types of market behavior? First of all, no pullbacks. And when there are pullbacks, they usually last only a bar or 2. The advantage of a breakout is that the market quickly goes your way. So if you buy, you quickly make a profit. The disadvantage is no matter where you buy, especially if you're buying after it's already lasted 3 or 4 bars, your stop is far below. So yes, the chances are if you buy, you're going to make money. So the probability is high. But so is the risk because the stop is far below. And that's always the case. Whenever you have a high probability of success, your risk-reward profile is going to be bad. There has to be a reason for somebody else to take the opposite side of your trade. And a strong bull breakout like this, it has to be risk-reward. So the institution selling to you when the market is doing this, they know that they're probably going to lose money or that it's very difficult to make money. They will have to use an extremely wide stop and scale in. But they have very good risk-reward because if they sell at any point and the market reverses, their risk is very little and their reward is very great. You should not be selling when the market looks like this. You should only be buying. And if you do sell, it's virtually impossible to make money during a bull breakout. When you're trading this, it's good to enter as early as possible, but you can even enter late and still make money. But the later you enter, the further away your stop is, so your risk is greater. Bulls will buy for any reason. They'll buy the close of bars. They'll buy at the market. They'll buy above bars. It doesn't matter. The key is to look to buy, and most importantly, don't sell. Do not sell. On a smaller time frame chart, there are pullbacks and channels. And on a small enough time frame chart, there might even be broad channels and certainly trading ranges. So for example, if this is a daily chart, and then you look at a 5-minute chart, there may even be some bear trends within it. For example, this tail on the top of this bar on the daily chart was probably caused by a trend down on the 5-minute chart. A tight bull channel, it's a bull channel, and on a higher time frame chart, it's a breakout. So if this is a 1-hour chart, every bar 1 hour, if you look at a daily or a weekly chart, it may be simply 2 or 3 consecutive bull trend bars. What distinguishes it from a breakout is that on this time frame, there are pullbacks. The low of this bar is below the low of that bar. And there are 2, 3, 4, sometimes many pullbacks. However, the pullbacks are usually brief, 1, 2, or 3 bars. Sometimes they're simply sideways, and it's very difficult to make money selling. So just like a breakout, traders should only look to buy. The market's clearly always in long. If you had to be in the market, you should only be long. Just like with a breakout, the stop is far below, So no matter where you buy and for whatever reason you buy, your risk is great. But like I said, this is a strong breakout on a higher time frame chart. Your probability of making money when you buy is high. You can buy again for any reason. You can buy closes, you can buy below bars betting reversals will fail. You can buy breakouts of bull flags. You can buy bear closes betting that reversal attempts will fail. When the market is strong like this, just like with any breakout, it's best to buy for a swing trade, but experienced traders might scalp as well. The disadvantage of scalping in any kind of a breakout or a tight bull channel is that you may not get back in. So you'll scalp, take your profit, and then miss the rest of the trade. However, if you're able to re-enter, especially if you're able to re-enter repeatedly, then you can scalp. However, you'll make more money. Most traders will make more money if they simply swing trade. Again, on a smaller time frame chart, so if this is an hourly chart and you looked at a 5-minute chart, this is 2 hours down. This is 3 to 4 hours sideways to down. On a smaller time frame chart, this tight bull channel contains maybe a broad bull channel trading range, and on a small enough time frame chart, it contains some bear trends. On a higher time frame chart, it's simply a breakout, a series of consecutive bull bars, and you don't even see the pullbacks and you do not see the bear bars. The third pattern is a broad bull channel. It's a bull trend, starts in the lower left, goes to the upper right, has higher highs and higher lows. However, unlike a tight bull channel, here the pullbacks last 5 bars, 10 bars, sometimes 20 bars, and sometimes the pullbacks are so deep, the market, at least temporarily, becomes always in short. When you see a chart that looks like that, while it's still easier to make money buying, the pullbacks are deep enough that some traders will sell as well. In general, if you're selling and the trend is still bullish, it's better only to be scalping. As I said, even if the market does become always in short, briefly like this, it's still forming higher lows. It's always in short, but only for a short period of time. And it keeps forming higher lows. Each low is above the prior higher low, and therefore it's a bull trend. As the trend is going up, the probability is the market's going to go higher. If it pulls back to around 50%, the probability still is that the market's going to go higher. The probability that it's transitioning into a trading range and a 50-50 market only reaches 50-50 if a pullback falls about 2/3 of the way down. In the first 5 or 10 bars of this pullback, it's 50% or less. There's still a 60% chance that it's going to go up and at least test this high. However, once it pulls back to about 2/3 or so, at that instant, when it was a bear bar on its low, the probability was 50-50 that it was going to resume up or go back down. A lot of bears will trade the market for scalps. Every new high, they'll sell. Here, the bears lost. If they sold at this high, the market broke out again. And that's one of the main reasons why it's better only to be looking to buy, even if the channel is broad. Experienced traders will trade both ways, but beginners should only be looking to buy as long as the market is always in long. Easiest way to trade it, buy pullbacks. Remember, breakouts, tight channels, I said you can buy at any time. You can buy the high of the bar, the high of 5 bars, and keep buying. If a channel is broad like this, bulls are taking profits at new highs. They're not buying at new highs, they're taking profits, and it's causing pullbacks. They buy during a pullback, and they sell at a new high to take profits. Bears sell for a scalp. On a smaller time frame chart, there are trading ranges. There are often trading ranges on this chart as well. But if this is an hourly chart, and you looked at a 5-minute chart, this would be about 15-20 hours of sideways trading. It would be just a big trading range. And the same is true here. On a higher time frame chart, this could be a very tight bull channel. And if you go to even a very high time frame chart, it could still simply be a breakout. For example, if this is a 5-minute chart and you looked at a 4-hour chart, it may be simply a couple big bull trend bars closing on their highs. Finally, trading range. Even a bull trend often has a trading range. Remember, a pullback is a trading range. So even a 1-bar pullback is a 1-bar trading range. In general, I only use the term trading range when a pullback lasts 20 or more bars. I use the term pullback when it's less than 20 bars, because if it's less than 20 bars, the probability is that the bull trend is going to continue. It's a pullback in the bull trend, implication, the bull trend will continue. If a pullback lasts 20 or more bars, the probability for the bulls falls to about 50%, the probability for a bear breakout rises to about 50%. And a trading range is a market that has 20 or more bars, and the probability of a bull breakout falls to about the same as a bear breakout. So when you see this, the chance of it having a bear breakout is the same as the chance of it having a bull breakout. It can come in a bull trend or in a bear trend. So what do you do in a trading range? Well, I said in a broad bull channel, bulls are buying pullbacks and taking profits at highs, and bear scalpers are selling at highs, and the opposite at lows. Well, a trading range is basically a broad channel that's flat, horizontal, and traders trade it the same way. Bulls take profits at highs, bears sell at highs, bears take profits near the low, the bottom third, and bulls buy in the bottom third, buy low, sell high, scalp. Both the bulls and bears are confident of only one thing, that the market's not going to break out and that it will continue to reverse. They both know eventually it will break out, but if they're trading it and it's in a trading range, they're going to be taking quick profits. So they buy low, sell high, and they scalp. For example, bulls buy a reversal up in the bottom third, and bears sell a reversal down in the top third, or they sell a breakout, betting that breakouts will fail. In a trading range, 80% of breakout attempts fail. Each one of these legs is an attempt at a breakout, an attempt at a bear breakout, attempt at a bear breakout, bull breakout. It even did break out, another attempt at a bull breakout. Markets have inertia, and they typically, 80% of the time, continue what they've been doing. So you just look to the left to see what the market has been doing. If you're here looking to the left, it's been going up and down and up and down. It's a trading range. Trading range probability is better for the bulls near the bottom and better for the bears selling near the top, but the probability is rarely better than 50-50. Again, bulls and bears are both confused except for one thing. They believe strongly that the market is not going to go very far up or very far down, and because of that, they scalp. They buy low, sell high, scalp. On a higher time frame chart, a trading range can be part of a trend, part of a channel. It could be part of a breakout on a high enough time frame chart. Again, every trend is made of one of these four components. I just talked about bull trends, and now I'm going to be talking about bear trends. And the same thing applies. Every bear trend is made of one or more of these four components. So if you look at any chart and it's in a bear trend, starting at the upper left, going down to the lower right, it's composed entirely of one of these four components. Each pattern may be only 1 or 2 bars long. Sometimes a pattern can be 20 or 30 bars long. For example, a trading range, it could easily be the entire chart. So we could have just a little bit of a sell-off and then a trading range and then a little bit of sell-off at the end. It's still a bear trend, but it's mostly a trading range. Bear breakout. Look at it. No pullbacks. Here's a minor attempt at a pullback. Sometimes there's a 1-bar pullback. But as long as it's mostly a series of bear trend bars with closes below, near the bottom of the bar, bottom half, bottom third of the bar, and not much overlap between the bars, I call it a breakout. And if you look at a higher time frame, it would be simply a large single bear trend bar. The only way to make money is sell. Sometimes you'll get an occasional bull bar. Sometimes you get maybe a 1-bar pullback. But as long as it's looking mostly like this with very little overlap, every bar having a low below the low of the prior bar, a high below the high of the prior bar, closes mostly below the close and lows of the prior bar. Anytime you see that, it's better only to sell. No matter where you sell, you stop as far away. So I said it's a high probability setup for making money as a bear. Whenever you have high probability, you have bad risk reward. It's a high probability that you're going to make money selling even all the way down here, but your stop is way up here. So your risk is great. You always pay for high probability with bad risk reward. Stop far away, and if you sell down here, there's a lot less profit left than if you sold up here. The reward is less, the risk is greater, but the probability is high. In general, if you're in a strong bear breakout like this, it's better to sell at any time for any reason and to sell for a swing trade. Experienced traders will scalp repeatedly. Scalping for beginners in a strong breakout like this, I think, is bad because they'll take one scalp and then they'll never sell again, and they'll make a scalp profit instead of a swing profit when the probability of a swing profit was high. And the most important rule in a bear breakout, do not buy. On a smaller time frame chart, there are pullbacks, and it's a tight bear channel. And if you go to an even higher time frame chart, it'll be a broad bear channel and a trading range. And on a high enough time frame chart, there would be even bull trends in it. So let's say this is a weekly chart, and if I looked at a 60-minute chart, there was probably a bull trend in here lasting 2 or 3 days. On a small enough time frame chart, the market may even be always in long. But if this is the chart you're trading, you only want to sell. Here we have a breakout initially, but then we get a pullback, and then another pullback, and another pullback, reversal attempt. Most of the pullbacks are only a bar or two. The market is going down in a fairly tight channel, so if I drew a channel line below and a trend line above, it would be a pretty tight channel. And if I look at this on a higher time frame chart, it's going to be a breakout. So if this is a 5-minute chart, and I looked at an hourly chart, this would be 2 big bear trend bars. And because it's a breakout on a higher time frame, it's better only to look to sell. The market stays always in short the whole time, and when that's the case, it's better only to sell. Just like with a breakout, no matter where you sell, your stop is still going to be up here. Your probability of making a profit is high if you're selling, again, for any reason at any time, but your stop is still up here. If you're selling down here, anywhere in here, your risk is big, but your probability for making money is high if you're selling. And as I said, anytime you have a high probability of making money, there has to be a reason for an institution to take the other side of the trade. He gets risk reward. His risk will be less, his stop will be closer, and his reward will be more, but he'll probably lose money. If he structures the trade correctly and manages it correctly, he can make money, but as an individual trader, if you see a market that looks like this, it's very difficult to structure a profitable long, so it's better only to sell. Selling for any reason, selling bear closes, selling above bars, selling bull closes, selling below bars, breakouts of bear flags. Those are all good things to do. Simply selling at the market at any time. The probability is high that the market's going lower, so it's best to only sell. And if you're starting out, even for most traders, it's better to swing at least part of the position. And if you're scalping, it's better only to scalp if you're able to get back in and scalp repeatedly. The most important rule, the same with a breakout, you do not want to buy. Again, on a smaller time frame chart, this tight channel is a broader channel, and it has trading ranges, and if you go to a small enough time frame chart, it would even have brief bull trends. On a higher time frame chart, as I said, a tight channel like this is going to be a breakout, and you usually do not have to go to a very high time frame chart. If this is a 5-minute chart, you simply look at a 60-minute chart, and it's probably 2 or 3 consecutive bear trend bars, which is a breakout. A broad bear channel is a channel, and it's a bear trend. It's a bear trend. It starts in the upper left, goes to the lower right. It has lower lows, lower highs. But unlike a tight bull channel, here, pullbacks last 3, 5 bars, sometimes 10 or more bars. Sometimes there are trading ranges within it, triangles, trading ranges. And sometimes the market reverses up strongly enough to be always in long. However, even when you get a strong bull reversal like this, a pair of consecutive bull bars again here, the highs still are lower. So it's still a broad bear channel, even though at times it's pretty bullish. Now, in general, as long as it's in a bear trend, any kind of bear trend, tight channel, breakout, broad bear channel, the probability is the market's going lower. And for a broad bear channel like this, as long as a pullback stays below maybe 2/3 of the height of the prior sell-off, the probability is the market's going lower. If you get a pullback that goes up maybe 2/3 of the height of the prior sell-off, if the pullback goes all the way up here, it becomes 50-50 whether or not it's going to go lower or go higher. In general, because it's a broad channel and the bears are taking profits at new lows and selling rallies, the bulls know that, so they're doing the opposite. They're buying new lows and scaling in lower, confident that pullbacks will go above breakout points. This is not really a good example. We barely reached the breakout point there, and here this pullback barely reached that point. But in general, bulls will start buying at the prior low and scaling in lower, and then on a rally back to the prior low, they get out break even on their first buy, and then with a profit on their later buy. Most traders should only be selling rallies and not worrying about buying, unless the channel is so broad and so flat that it's almost a trading range. Some bulls will buy reversals up, especially here we got a second entry buy. Others will buy at the prior low and buy more on the reversal up. And then when the trend resumes down, here we have a double top bear flag or a wedge. 1, 2, 3. They sell out of their longs for a scalp. And bears will sell these breakouts of bear flags as well. On a smaller time frame chart, this is an hourly chart, it will contain trading ranges. That would be a trading range, this would be a trading range. And on a higher time frame chart, usually a tight channel, and if you go to a high enough time frame chart, it may even be a bear breakout. Trading ranges. This is exactly the same chart that I use for the bull channels, and you trade it exactly the same. 50% probability that a successful breakout will go up, 50% probability that the eventual successful breakout will be down. The one thing that traders feel confident about is that 80% of breakout attempts will fail, and because of that, they're looking to sell high and buy low, and because they're not expecting the market to go very far, they scalp. Both bulls and bears sell high. Bears sell high to put on shorts, bulls sell high to take profits on longs from the bottom. In the bottom third, bears buy to buy back their shorts with a profit, and bulls buy for a scalp up. So you want to buy low, where the probability is highest for making a profit and the risk is less, and you want to sell high, where the probability of making a profit as a short is highest and the risk is less as well. Traders will sell at the prior high, they'll sell on a reversal down. At the bottom, here we have a second entry buy. Here we got a reversal up, another double bottom and a micro double bottom. The market went down, up again. Both the bulls and bears are scalping because they know the reward is small, and that's how you should trade it. So you want to be buying low, selling high, and taking quick profits. Again, on a higher time frame chart, it can be part of a bull channel, part of a breakout, but on this time frame, it's a trading range, and you buy low, sell high, and scalp. I want to talk some about trends, and trends are either breakouts or channels. So a breakout is a strong trend, and a channel is a weaker trend. A trading range, it can be as short as 1 bar or as big as the entire chart. And as I said, if a trading range is brief, I call it a pullback because I'm assuming the trend that came before it will resume. Once a trading range reaches 20 bars or more, the probability of a bull breakout is about the same as for a bear breakout. So the market cycle is this. It trends and enters a trading range, and then the trading range breaks out in either direction, and then you get another trend, and the process just continues to repeat. All trends begin with a breakout. It can be a single bar, or it can be a series of bars. For example, here we have a bull breakout. Remember, every bull trend bar is a breakout. It's also a climax. The breakout is the strongest type of trend, and there is no significant pullback, and sometimes it can last several bars. However, once you get a pullback, you've begun a channel. Pullback in a bull trend means the low of the bar goes below the low of a prior bar. We have a breakout, and then this bar fell below that bar's low. The market is now going to probably transition into a channel. Very unlikely for a bull trend to become a bear trend. Typically, when you have a strong bull breakout like this, you get a pullback, and then you get a weaker trend, a tight bull channel, sometimes a broad bull channel. So when you get a pullback, low below the low of the prior bar, probably the breakout phase has ended. If we get another series of bull trend bars, then I would say this is still part of the breakout. But usually when you get a pullback bar like this, especially a bear bar and a pair of bear bars like this, the market is transitioning from a breakout phase into a channel phase. And then now, once we see this, a breakout bar with a bear bar, another bear bar, a fairly deep pullback, traders will conclude that the breakout definitely has ended. They don't know at this point if it's still in a fairly tight bull channel or instead in a trading range. But in any case, the breakout phase has ended. And here, the channel phase begun. We pull back again, a double bottom, a higher low double bottom, but we're making higher lows and higher highs, so it's a channel. And this particular channel is fairly tight. A lot of bulls are momentum traders. By momentum trader, what they see is the market going up, and they buy because it's going up. And that's all they care about, and they just keep buying as long as it keeps going up. During strong bull breakouts, they're momentum traders. They're buying for any reason. So as soon as the bar closes, bull close, I'm going to buy, I'm going to buy, I'm going to buy. We haven't had a pullback after 5 consecutive bull bars. We're getting a reversal attempt. I'm going to buy the low of this bar. I'll get filled here, betting that the reversal will fail. They buy because they expect that other traders will buy from them at a higher price, and they will be able to sell to those traders and make a profit. So high probability of making money buying when the market looks like this, but risk is big because your stop is far below. Some bulls are value traders. Some bulls are momentum traders. They just keep buying as the breakout is continuing, confident that they'll make money. Other bulls rather buy pullbacks because they want to reduce their risk. By buying a pullback, you're buying at a time when the bull trend is not quite as strong, so the probability of a profit is less. You're taking the trade to reduce your risk, but at the same time, the price you pay is slightly less probability. So a trader might see this and decide, I don't want to be buying when it's going up that fast. My stop is too far away. Instead, they'll wait for this, a double bottom bull flag, and they'll buy with a stop above that bar, or they'll buy with a stop above this bar, buy with a stop above this bar. For example, let's say they buy above this bar, this bar, this bar. As soon as you get that breakout, they'll put their stop here instead of down here. So they're reducing their risk, but the market is not as strongly bullish here, so they're also reducing their probability. Value traders are taking trades that have less risk, but also less probability. Momentum traders are taking trades with a very high probability of making money, but their risk is greater. Their stop is further below. A value trader, they buy for any reason. As soon as you get a new strong breakout, you raise the stop. New strong breakout, raise the stop. New strong breakout, raise the stop. Channels eventually evolve into trading ranges. Rarely a bull channel will have another bull breakout and an even stronger bull trend, but at least 75% of bull channels have bear breakouts. So I always think of a bull channel as a bear flag, no matter how strong the bull trend is. Here we have a bull trend and a bull channel. 75% chance we're going to get a breakout below the bottom of the channel. So 75% chance the bull channel will have a bear breakout and it will evolve into a trading range. One of the things I pay attention to is, can the bears make money? That's really important. How easy is it for the bears to make money? Can the bears make money here? No, really difficult. Here, really difficult. But look right here. If a bear sells at the prior high, he could scalp here. If he sells at this high, he could scalp here. So if it's easy enough for the bears to make money, the more likely the channel is beginning to transition into a trading range. So it's really important. Sometimes I'll get traders complaining to me, Al, you're always talking about bulls and bears. Why don't you make up your mind? Pick one and don't be so afraid. The reason I talk about bulls and bears all the time is because of the market cycle. I'm always talking about entries, and I'm always talking about risk and reward, how to structure trades, because there are entries in every bar. If you understand what the market is doing through here, you can enter at any time. If you look at the volume of these bars, the volume is big on every bar. So it's not like the institutions are all buying on this bar or this bar and not the other bars. They're buying on all the bars. And if you look at the volume on these bars, it's also big. That means the institutions are buying on every bar. That means there's a reason to buy or sell on every bar. And because of that, I'm always paying attention to whether or not the bears can make money in a bull trend and can bulls make money in a bear trend, because it tells me where we are in the market cycle. Here, I know we're clearly in a bull trend, strong bull breakout. And now we're in a channel. I know channels usually evolve into trading ranges. And one of the signs that it is evolving into a trading range is that bear scalpers are making money selling at the prior high. So I pay attention. Are the bears making money? First of all, you get the limit order bears selling at the prior high, and it's falling probably enough for a scalp. And then stop order bears. Once the stop order bears begin to make money, chances are we're in the early phases of a trading range. So a bear scalper sells at that high and takes a small profit here. He made money, and then he does the same there. And then the stop order bears, once I see stop order bears making money, then we're probably in the early phases of a trading range. I'm thinking that, okay, bull breakout, bull channel, and here we have 3 consecutive bear bars closing on their lows. That enough is to make me think we'll get at least a second leg sideways to down. And I see bears who sold with a stop below bars are now making money. That increases the chances that we're leaving the channel phase and entering the trading range phase. In a bear trend, every bear trend begins with a breakout. It can be 1 bar, it could be 5 or 10 bars. Here, it's 3 bars. It's the strongest part of the trend, and there's no significant pullback. Sometimes there might be a bull inside bar like this. Sometimes there may be a 1 bar pullback. But in general, most of the bars are like this. Very little overlap, big bear bars closing near their lows, lots of gaps, close of this bar, low of that bar. And on a higher time frame chart, it's probably simply a single bear breakout bar. Again, it could be a single bar, it could be several bars. This example has 3 bars. And as soon as there's a pullback, then the breakout phase usually has ended and the market has begun to enter a channel. So as soon as a bar goes above the high of the prior bar, there's a pullback. Here, this bar went above the high of that bar, so a pullback. Chances are the breakout is over. You can say the breakout continued down here. To me, this is the breakout phase, and this is enough of a pullback to make me think that the channel has probably begun. At this point, here we have 3-bar pullback, 1, 2, 3. We have 2 bull bars, and it's following fairly closely after this pullback. So at this point, I think we are in a channel. We still have lower highs and lower lows, so it's still a bear trend, but it's a weaker trend. Now it's a channel. As soon as you get a pullback, either here or here, traders begin to decide the breakout phase has ended and it's now a channel. If the channel is tight like this, all the pullbacks lasting 1 bar, sometimes 2 or 3 bars, then it's better only to be shorting. And on a higher time frame chart, it's probably still a breakout. Different ways to draw the channel. You can draw it like that. You can draw it tighter and just use this, consider this to be an outlier, and just draw a trend line like that. Just like some bulls are momentum traders, some bears are momentum traders, and they are willing to sell all the way down, even when the market's extremely strong and the stop is far away. They believe that probability of making money is high. They know that their stop is far away, and they're willing to take the bad risk-reward trade because of the high probability of making money. So they're willing to sell at the low, expecting that any pullback will be brief and that the market will go lower and they'll be able to take a profit. So high probability, but big risk. Momentum traders, they'll sell at the low. They don't care. Some bears are value traders. They don't want to risk that much, and they're willing to pay for reduced risk by accepting lower probability of profit. Those traders, they only want to sell if the market's expensive. So they're looking to sell pullbacks. That way there they can use tighter stops, less risk. Let's say you sell below this bar and then you enter in this bar, you have a bear breakout, your stop is up here. So your risk is less. Momentum traders selling down here, their stop is up here. They have a higher probability of profit. Value traders are selling here, anywhere up here, because the market's expensive. So they're getting good value on their sell. Here we got a low 2 bear flag, 2 legs up, 1, pullback, 2. So low 2 short. You can also call it a triangle, 3 pushes up, 1, 2, 3. And you'll sell the breakout and use a tight stop. So low risk, but they got to pay for it somehow. And because you're selling when the market is going sideways, your probability is a little bit less. And you're also going to have slightly less reward because you're also selling later in a trend. Bear channels are bull flags, just like bull channels are bear flags. 75% of bear channels ultimately have a bull breakout. Only 25% have a successful bear breakout and an acceleration down. Probably even less than that. Same with bull trends. So anytime I see a bear channel, I'm assuming it's going to transition into a trading range, which it does more than 75% of the time. Now, one of the things, just like I talked about in a bull trend, can the bears make money? In a bear trend, I want to know, can the bulls make money? I can see the bulls who bought here, bought more lower, they made money here. They did not make money here. They buy that low. This high did not get above that low. But here, if they buy this breakout right here, they made money. That's the first sign that the channel is beginning to weaken, that the bears are losing control and that the bulls are getting stronger. So it's the first sign that the market might be transitioning into a trading range. So I want to see, can the limit order bulls make money? They made money here. They did not make money here unless they held and added on here or here. And they did make money pretty quickly here. Can limit order bulls buying with limit orders at the prior low, make money? Again, I pay a lot of attention in a bear trend to the scalping bulls, the limit order bulls. Because if they can start to make money, and I've been shorting, I'm going to start to transition how I'm trading. I'll start taking quicker profits, and I'll start switching from momentum trading, just selling at the market, to value trading, selling pullbacks. And if it's easy enough for the bulls to make money, I'll start buying. Once you get a profit from a stop order bull, here we got a lower low, breakout of a triangle late in a bear trend, usually a final flag. Not a good buy signal bar, bear body, but here now we have a second entry buy, higher probability for a stop entry bull. And when stop entry bulls begin to make money, chances are the market has transitioned into a trading range. To me, I find it very useful to pay attention to whether or not limit order bulls can make money in a bear trend, because it tells me that the market might be transitioning into the next phase, a trading range. Just like I pay attention to a breakout. As soon as it has a pullback, it tells me that the market is transitioning into a channel. I talked about the 4 parts of the market cycle: a breakout, and then a tight channel, and a broad channel, and then a trading range. I said that when you're in the breakout phase, you only want to be trading in the direction of the trend. So if it's a bear breakout, you only want to be selling. As soon as there's a pullback, the breakout has ended, and now the market's in a channel. If the channel is tight, again, trade it like a breakout, only sell if it's a bear channel. If it's a bull trend, you only buy. If the channel is fairly broad, you can trade in both directions. But in general, it's better to swing in the direction of the trend and scalp in the opposite direction. So if it's a broad bull channel, you buy pullbacks and you can hold part for a swing, but bears can sell new highs and scalp. And eventually, a channel evolves into a trading range. And then after the market's been in a trading range for a while, it breaks out, and the breakout has about the same probability of going up or down. So a trading range is neutral. The probability for the bulls and the bears has fallen to 50-50. This is Al Brooks, and thank you for watching the Brooks Trading course. This is the end of the first of 3 videos on the market cycle. This is Al Brooks. Thank you for watching the Brooks Trading course. This is the second of 3 videos on the market cycle. When I'm trading, I always think of every chart as either being in a trend or in a trading range. For that matter, I think of every bar as either being a trend bar or a trading range bar. Now, I have a rule, my Al Brooks 80% rule, that markets have inertia and they tend to continue to do what they've been doing. So if a market's in a trend, 80% of reversal attempts will fail. If it's in a trading range, 80% of breakout attempts will fail. Finally, I'm going to talk a little bit about definitions: trends, swings, legs. Now look at this chart. Bear trend, bull trend, bear trend, bull trend. Bull trend has higher lows and higher highs. Same chart, bear trend has lower highs and lower lows. And same with over here. Trading range, it always contains components of an early bull trend and an early bear trend. So this is a trading range, but it has a higher low. This is a trading range. It has a lower high, so it has a bear trend, but it also has possibly a bull flag, a wedge bull flag after this bull trend and a 50% pullback, so it's also a bull trend. So a trading range, anytime you see the market going sideways and there looks like a reasonable sell setup, here we got a double top, so neckline, so double top bear flag, but we also have a higher low major trend reversal. Here we have a head and shoulders top, but we also have a wedge bull flag and a 50% pullback. Anytime you look at a section of the chart and you can come up with a reasonable buy setup and a reasonable sell setup, you have to assume the market's in a trading range. Trading ranges can be any size. They can be a single bar, they can be 100 bars or more. When the pullback is brief, like 1 bar, 5 bars, even sometimes 10 to 20 bars, if the context is right, the odds are the trend will continue. When there's a trading range in a bull trend or in a bear trend, and the trend is likely to continue, I call the trading range a pullback. It's a pause in the trend, and you expect the trend to continue. Bull trend, pause, small trading range, so I call it a pullback. Odds are the trend will continue. So the breakout usually is in the direction of the trend. Now look at this. Let's say this is a 5-minute chart. It's a 5-bar pullback on a 5-minute chart. On a 60-minute chart, it's probably no pullback at all. And if you look at a 1-minute chart, it's 25-bar pullback. So all pullbacks, even though the odds are on the 5-minute chart, the trend will resume up. Because it has more than 20 bars on the 1-minute chart, the 1-minute chart could easily trend down further instead of trending up. So the probability is more neutral. Ultimately, even if it did trend down further, because of the 5-minute chart, if it came down here, even for a measured move down, the odds will still be that it would go up. But on the 1-minute chart, because it has 25 bars, 50% chance that it will resume up, 50% chance there'll be a bear breakout. But even if there is a bear breakout, it would still be a pullback on the 5-minute chart, and therefore the bull trend would likely resume. Here we have a 1-minute chart. And a 25 bar trading range, well, a 25 bar trading range on a higher time frame chart could be simply a pullback in this bull trend. And in fact, obviously it is. On a 5-minute chart, this 25 bar trading range on the 1-minute chart is just a 5 bar trading range on a 5-minute chart. So all pullbacks are trading ranges on smaller time frames, and all trading ranges are pullbacks on higher time frames. As I said, once a pullback lasts 20 bars, 30 bars, 40 bars, the prior trend is so far to the left that it loses influence, and the market becomes increasingly neutral. Usually, when a pullback grows to 20 bars or more, I call it a trading range. And once I do, what I'm saying is the probability of trend reversal up now is as great as the probability of trend resumption down. So the market has lost its direction, and the bulls and bears have become balanced. So the market's in breakout mode, which means it can break to the upside. Same probability, it could break to the downside. And when it does break out, traders will look for a measured move. So if it breaks to the downside, they'll look for a move that's this high down here. If it breaks to the upside, they look for a move equal to the height of the range going up. And here we got trend reversal. Bear trend, head and shoulders top, bear flag, but we ended up getting a bull breakout. Because, as I said, once a pullback grows to 20 or more bars, it's a trading range and it's neutral, and the probability of a reversal is about the same as the probability of trend resumption. Bear trend, trading range, 20 or more bars, probably about 40 bars here. 50-50 chance you'll get a reversal, 50-50 chance you'll get trend resumption down. For the bulls, they see a double bottom bull flag. They want to break out above the neckline, measure move up. And for the bears, they see a double bottom, and they expect the double bottom to fail. So they see a lower high in a bear channel, another lower high, and they're expecting the downside breakout, which they got. And they're also expecting the breakout to go about a measured move based upon the height of the range. So here's the height of the range. Measured move down is around there. There's the measured move. My 80% rule, inertia. Inertia means that an object tends to continue what it has been doing, and markets tend to continue what they've been doing. If you want to know what the bars to the right look like, the ones that you do not see, they probably look like the bars to the left. Whenever you're in a trend, here a bear trend, the market's constantly trying to reverse. But 80% of the reversal attempts will fail. They become bear flags, and the trend continues. Every time it reverses, bear flag. Reverses again, bear flag. You can call this a wedge or a low 2 bear flag. You can call it a double top bear flag. Doesn't matter. Here, a very strong reversal up, but it's still a lower high, so it's a double top with that, smaller double top with that. Even with the strong reversal up, it's still not enough to reverse the trend. We're still getting lower highs and lower lows. Lots of reversal attempts. A good-looking buy signal bar, good-looking buy signal bar, micro double bottom, bull inside bar here, trying to reverse up, trying to reverse up. It's constantly trying to reverse. All trends are constantly trying to reverse. And 80% of the reversal attempts fail. Now look at this. We're in a sideways market. And as I said, markets continue to do what they've been doing 80% of the time. And what are we doing here? Well, we're going down. No, we're going up. We're going down. We're going up. Well, what do you think the bars to the right look like? Probably the ones to the left. So trading ranges are constantly trying to break out. New low, new low, new high. But 80% of the breakout attempts fail. So lots of new lows, lots of new highs. But markets have inertia. That's my 80% rule. 80% of trading range breakouts fail. 80% of trend reversal attempts fail. I want to talk a little bit about terms. Sometimes you hear traders talk about swings and pullbacks and legs and trading ranges, and they don't really explain exactly what they're meaning. And a lot of traders use the terms differently. I tend to use them in a fairly conventional way. And sometimes the terms are interchangeable. So is this a leg? Is it a swing? Is it a trend? Yes, it's all of those things. Trends usually, you're thinking about 10, 20, 30 bars. This is an early trend. Trends are made up of legs. It has a bull leg, a bear leg, a bull leg, a bear leg, bull leg. And swings are also made up of legs. So we got a bull swing, a bear swing. A swing simply means a leg that's far enough to make a swing profit. So swing profit usually is about 4 times the size of a scalp. If you're talking about a Forex market, a scalp might be 10 pips. So a swing would be 40 pips or more. If the legs are 40 pips or more, I would call them swings. If they're less than 40 pips, I would call them legs. The entire chart is a bull trend because it's getting higher lows and higher highs. And within it, there are swings down, certainly legs. Anytime I see a trend, any move, I call a leg. A leg up, leg down, leg up, leg down. If the leg is big enough for a swing trade, I call it a swing. And if it's a series of higher highs and higher lows lasting a lot of bars, I call it a trend. What's going on here? Is this a bear leg, a bear swing? Is this a bear leg, bear swing? Or is it a leg in a trading range? Doesn't matter. I call this a trading range. I would call that a bear leg, a bull leg, a bear leg that subdivided into smaller legs, down leg and up leg and down leg. So in general, any small move I tend to call a leg. A bigger move where a person can make a swing profit, I tend to call it a swing. And if the trend lasts for most of the chart, I tend to call it a trend. In general, anytime there's a diagonal move up or down and it occupies most of the screen, I call it a trend. And if there are more than two on the screen, I don't use trend. If there are just two, I'll call it a trend. So this is a bear trend, this is a bull trend. But if I start to see 3 or 4 trends on the screen, I stop calling them trends, I call them swings. If I start to see 5 or 10, I start to call them legs. So there's a bear trend and there's a bull trend. Bull trend has higher highs and lows. Well, I distinguish higher highs and lows into major and minor. A major higher low is a higher low that has a strong breakout, usually to a new high. So that's a major higher low. And this is a minor higher low. It's a higher low, but the breakout is not all that strong. So more likely it's a leg in a trading range. These are major higher lows. Major higher low, major, followed by a strong bull breakout, usually to a new high. Not always, but usually to a new high. If it's a trend, bulls tend to raise their stop to just below the most recent major higher low. For example, if a bull bought here, he would not raise his stop here. He would keep it below the most recent major higher low. And as long as the market's making major higher lows, it's in a bull trend. And if it falls below a major higher low, bulls will start getting stopped out, and the bull trend probably has evolved into a trading range, possibly into a bear trend. So you want the pullbacks to stay above major higher lows. Minor higher lows, as I said, these are all minor. They do not lead to strong bull breakouts. And they're usually legs in trading ranges. So a minor higher low. See, we went below it, but we're still in a bull trend. Minor higher low, and then a lower one. But when you see these, do you think the trend has converted into a bear trend? No, as long as it's still above the bottom of the most recent strong bull breakout, a major higher low is still a bull trend. These are all minor, and you expect them to be part of a trading range or part of a pullback. So is this major or minor? It's a higher low. It held above the bottom of this major higher low. Major because there's a strong breakout, new high. This is followed by a breakout, but not a strong breakout. A small bar here, small bar there. Doji, bear bar. So this is probably a minor higher low. But because it's minor, the market could easily fall below it and still be in a bull trend. The market fell below a minor higher low, but it still held above a major higher low, and therefore it's still a bull trend. It led to a bull leg in a trading range and not a bull leg in a bull trend. Did not lead to a strong breakout to a new high. And trading ranges have legs up, they have legs down, and sometimes the legs down fall below minor higher lows. Lower low, but it converted the bull trend into a trading range. We have a bear breakout and a lower low, but we held above the major higher low. So at this point, pullback grew into a trading range still in a bull trend. The odds still favor trend resumption up. I said before that if a trading range grows to 20 or more bars, the probability of a reversal becomes equal to or close to equal to the probability of trend resumption. And I was careful with my word selection, and I said close to. Every bar that gets added reduces the probability of a bull breakout. But as long as the market's holding above the prior higher low, the probability still is slightly greater for the bulls. So at 20 bars, it's close to 50-50, maybe 53% bull breakout, 47% bear breakout. But as long as it's holding above the higher low and does not have a strong reversal down, the odds still are slightly greater that the market will resume up. Trading range, one leg down, a little bit complex, pullback, and the second leg down. Large high 2 bull flag, one leg down, pullback, 2 legs down, and the second leg down also subdivided and went down, up, and down. Still above the bottom of the major higher low, the bottom of this bull breakout. Not just the bar, but the breakout began here. It's good that it stays above the bottom of the bar. It's better that it stays above the bottom of the bull leg, and it's better that it stays above the bottom of the entire swing. Most bulls would put their stop down here, maybe below here. Major because strong breakout to a new high. Rally here was only a bull leg and a trading range, not a resumption of the bull trend. Bear trend, strong breakouts. 2-bar, 3-bar breakout here, breakout, lots of breakouts here. And this is a pretty major lower high, followed by a strong breakout to a new low. As long as it's a bear trend, rally should not get above this high, so that's a pretty major high. Now, is this a major lower high? Well, it probably is. You got 3 bear bars closing on their lows, 2 of them pretty decent size. So at this point, a lot of bears will put their stop above this high. Now, I said earlier that a major reversal like this does not always lead to a new extreme. So in this case, I think this is major enough so that bears would tighten their stops to here. They would move the stop from here to here after they see that 3rd bear bar. Even though we did not get to a new low, it's a strong enough breakout to make bears tighten their stops, and the market should not get above this high. I call it a major lower high. It's obviously not as major as this, but still, most bulls would start buying above that high. Most bears would get out above that high. So it's a major reference point. A major lower high usually gets a breakout to a new low. Usually, not always. Every time you get the breakout, traders tighten the stops. Strong breakout, lower the stop to just above the most recent lower high, the most recent major lower high. Is this the lower high? I would say up here is where I'd put my stop. Pullback sometimes can have 2, 3, 4 legs. So we got 1 leg, a low 1, low 2, and then a low 3. So this is a low 3 and a lower high in a bear trend. So you can call it a wedge bear flag, you can call it a wedge lower high, but it's a major lower high. And each one of these pushes up creates a minor lower high. This did not have a strong breakout to a new low. This had a 1-bar breakout, but not all that strong, did not even fall below this bull bar. And here, another bull breakout, pretty decent bear breakout. So I would call these 2 minor lower highs. And then by the time this 3rd bar closes, I would call that a major lower high. Minor lower high usually leads to little legs in a trading range and not reversals or resumptions down. And we went down for 1 bar and then trading range price action here. So is this a major or a minor lower high? Is this the major lower high or is this? Well, this clearly is a major lower high. This, I think, is not major enough. We had a couple bar breakout, not enough of a pullback. So I think this is simply a pause in this strong bear breakout. I personally would not put my stop above that. I would keep my stop up here. And you can see this went above that. This is, I think, a minor lower high, and this is a minor lower high. This is the major lower high. And when you're in a bear trend and it starts to get a pullback with a lot of bars, very often it goes above minor lower highs, but the trend is still intact and you expect another new low. If it goes above a major lower high, the bear trend, most traders would look at the bear trend as being over. And when a bear trend ends, usually it converts into a trading range. Sometimes it'll immediately convert into an opposite trend. For a bull trend, you need a strong bull breakout and follow through above major lower highs. We broke above a lower high, we broke above a lower high, so we got a breakout here. That is not a strong bull breakout, it's just 1 bar with terrible follow through. So we need breakout and follow through. So we got a decent breakout but bad follow through, and it did not get above a major lower high, it just went above minor lower highs. So this is probably not a bull trend, it's probably a bull leg in a trading range or a bull leg in a bear trend. Sometimes you get major lower highs, and as I said, they're not always followed immediately by a new low. For example, here we have 3 consecutive bear bars breaking below a wedge bull flag. I think this is enough for traders to believe the trend has resumed, even though we did not get down to a new low. I would call that a major lower high, as I said. Over here, look at this. We got a double top and then a breakout. I would call this a major lower high. The bears do not want the market going back above a double top after a decent breakout and a new low. even though it looks relatively minor. I think a lot of the bears after this breakout will lower their stops to above this double top. If a trend lasts only about a third of the chart or less, it's minor. Remember I said that if there's only one trend on the screen, I call it a trend. Sometimes you'll get two trends on the screen, and I'll still call them trends if they clearly are trends. But if you get three or more trends on the screen, I stop using the term trend, and I start using other phrases like a leg or a swing or a pullback. And it doesn't matter what you call it. I tend to use the terms in particular ways. Every move is a leg, up or down, small, even if it's only one bar, it's a leg. So everything is a leg. And if it's big enough for a swing trade, I call it a swing. If it's big enough, and if there are only two moves on the entire chart, so like big up, big down, I call it a trend. This is also, it's a leg down in a bull trend. I'm getting higher lows, higher highs. So a leg down in a bull trend, leg down, leg down, leg down. And anytime you have a leg down in a bull trend and the trend resumes, that leg is also a pullback. So this is a bear leg and a bull trend, but you expect the bull trend to resume, so it's a pullback. And here we have a very strong breakout, and I would say it's another swing up. You can call it a bull leg, but when it's strong enough for a swing trade, I tend to use the term swing trade. And then here we have a pause after a bull breakout, and I would call that a pullback, a bull flag. You can call it a small sideways leg if you want. I would not call it a swing because nobody can make a swing profit there. And I would not call it a trend. So it's either a pullback or you could say a sideways leg. The swing usually lasts 10 to 20 bars and goes far enough for a swing profit. So a swing profit in general, about 3, 4, 5 times bigger than the smallest scalp. Bear swing, bull swing, bear swing, bull swing. Legs, I tend to use the term for moves that are too small for a swing. So sometimes it's just 1 or 2 bars. I generally use the term pullback, but if you start to get 5 or 10 bars, I tend to use the term leg. And they're usually parts of trading ranges or pullbacks in trends. So smaller than a swing, and a pullback is the smallest type of leg. So we're going to leg down, pullback, small leg down in a bull trend, bull breakout above a bear channel. Little leg down, little leg up, little leg down. And you can say these are 2 little legs and a bigger leg, a bigger bull flag. This went down far enough for a swing profit, so you can call it a swing down. Or you could simply say a leg down in what appears to be a developing trading range. Bull legs, bull leg here, bull leg there, bull leg here. Not really big enough for a swing, so I'd call it a bull leg. This is big enough for a swing, so you can call it a bull swing. Is it big enough for a trend? I don't know. You might call it an early bull trend or a swing up. Bull legs. A larger bull leg or big enough for a swing, so I'd call it a swing. To me, we're not getting enough in terms of consecutive relentless big bull trend bars. We have a pair of bull trend bars here, but we're still below that high. We broke above the high here, but could not close above it. I would tend to call this more of a swing up than a trend. In this video, I talked about the market cycle and how every chart is either in a trend or a trading range. Every part of every chart is either in a trend or a trading range. In fact, every bar is either a trend bar or a trading range bar. And then I also talked about my 80% rule. The market has inertia. It tends to continue what it's been doing, and it tends to resist change. If it's in a trend, 80% of reversal attempts will fail. If it's in a trading range, 80% of attempts to break out into a trend will fail. And then finally, I talked about definitions. Any move up or down on a chart is a leg. If the leg goes up far enough or down far enough for a swing trade, I tend to call it a swing. And if there's clearly a strong trend breaking out far beyond the bars to the left, as long as there are only 1 or 2 such big swings on the chart, I tend to call it a trend. If there are 3 or more, I tend to call them swings. And I tend to look at the chart as being in a trading range. This is Al Brooks. Again, thank you for watching the Brooks Trading Course. This is the second of 3 videos on the market cycle. This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the third of 3 videos on the market cycle. I talked about the first set of definitions in the last video. In this video, I'll be talking a little bit about pullbacks. Next, I'll move on to trading ranges. And finally, I'll talk about trying to construct binary decisions when you're placing trades. Any pause in a trend is a pullback, and it's also a small trading range, and traders expect the trend to resume. If the pullback grows to 20 or more bars, traders start to wonder if the trend will resume or reverse, and at that point, I stop using the term pullback, and instead, I switch to the term trading range. Here we got a bull breakout above a wedge bull flag, nested wedge, 1, 2, 3, 1, 2, 2, or 3. Pretty good bull breakout, and then we got a pullback here, a pause in the trend. When you see this, chances are this breakout's strong enough for at least a second leg up. So this pause is probably a pullback. Pullback means I expect the trend to resume. So anytime a bar in a trend falls below the low of the prior bar, it's a pullback. We're rallying again here. We got a bar here. This bar traded below its low. This is a pullback. And the pullback pulled back further to a second leg down. Bear bar, bull bar, and then second leg down. These are pullbacks in bull trends. And I say pullback because the odds are the bull trend will continue. Small wedge, a bear bar, a doji, a bear bar, a bull bar. First leg is here, second leg here, and then third leg ended with this bull reversal bar. This is actually the start of the pullback, even though the bull trend continued higher on this bar. And that's very common, that pullbacks begin before the trend ends. Is this high part of this bull trend? Yes. Is this high part of the pullback that began with this bar? Yes. When I look at this chart, at this point, I assume the pullback began here, and that this high is part of the pullback and not part of the bull trend. A pullback is any pause. So for example, if I have a bull trend and a bear bar, that is a pullback. Whether or not this low went below that low, I still call it a pullback. In this case, it did go below that low, so most traders would call it a pullback. Pullback can grow. It can grow into a trend reversal. You can see we broke below the bottom of the bull breakout. Once it breaks below a major low like this, traders stop using the term bull trend and say that it's either in a trading range or in a bear trend. I want to say one other thing about this slide. I said earlier this is a wedge bull flag. I think some computers look at this as a pullback from this breakout. Even though this went to a new low, I still, when I look at this, think that this looks like a weaker bear trend than this does a strong bull trend. I tend to look at this as a pullback from this bull breakout, even though the pullback fell below the bottom of the breakout. In a bear trend, typical definition of a pullback is a bar going above the high of the prior bar. So this is the first pullback. However, a smaller time frame chart, this bull bar is actually almost certainly a pullback. On the 5-minute chart, I would call it an implied or inferred pullback. It's a pullback, not on this chart, but on some lower time frame chart. I still view it as a minor pullback. This is an actual pullback on this time frame because it went above the high of the prior bar. So this is the first bar on this time frame that actually pulled back above the high of a prior bar in a bear trend. Talked about this a minute ago. Even though this bear channel fell below the bottom of this bull breakout, I still think of this as a pullback from this breakout. And I'm going to look to buy a reversal up. I might not buy above the doji bar, but I might buy above this bull bar or wait for that bull bar to close or buy below this bar. A lot of bulls would buy above this wedge, nested wedge, 1, 2, 3, small wedge, inside of what appears to be a bigger wedge, 1, 2, and then 3. I talked earlier about definitions of trends and legs and pullbacks and swings. This to me is a bull trend. Here's a 50% pullback, but it has a lot of bear bars, and the market probably went always in short. And the profit was probably big enough for a swing profit, so I would call it a bear swing. And any move up or down is a leg. So this is a leg, but it's big enough. I would call it a trend, big enough for a big swing trade. This is a leg down, big enough for a swing short. So I would call it a swing down. You can call it a leg. You can also call it a 50% pullback from this bull trend. And then we got a rally here, not strong enough for me to be thinking about it as a trend. I'm wondering at this point if it's a bull leg in a trading range. So it's a bull leg in a trading range. It went up far enough for a swing profit, so you could also call it a bull swing. And then likewise, we went down far enough for a swing profit. Clearly not a bear trend. We're not even making lower lows. We went down for a lot of bars, enough for a swing profit. I'd call it a bear swing. or you can call all of these legs, bull leg, and then a couple bear legs and a trading range, and a bull leg and a trading range. And they subdivide. Within it, there are smaller legs. Here's a little bear leg in this bull swing. And it's also a pullback from this beginning bull trend. Just like we have a bull trend here, 4 or 5 bars up and then a pullback to a higher low, 50% retracement of the rally. This is a pullback in a bull trend. And this is a pullback in a bear trend. The trend continued down. Now I'm going to talk a little bit about trading ranges. A trading range can be a single bar. This is a 1 bar trading range. That's a 1 bar trading range. If I think the trading range is so small and so insignificant to not alter the course of the bars to the left, I call it a pullback. So in other words, this is a small trading range, a 1 bar trading range, but it's not enough of a pause or interruption in the bear trend to make me think the bear trend has ended. I think the bear trend is going to continue down. So anytime there's a trading range and I think the trend is going to continue, I call that trading range a pullback. Trading range usually has to go to 20 or more bars before traders start to question trend resumption and they start thinking about a possible trend reversal. Pretty strong reversal up, micro double bottom, down, up, down, and sell climax. When you look at it, do you think that this is a bear flag, a pullback? Do you think that we're going to go down? Or do you think, oh, that's a pretty big bar up. I'm a little bit confused. So big down, big up. Plus we went up and down on this bar and then up again. So when you look at that, are you thinking pullback or are you thinking confusion? If you're thinking confusion, that is one of the hallmarks of a trading range. Now we have 3 bull bars, 1, 2, 3, closing on their highs. Do you think this is a pullback and that the bear trend will resume down? Or are you saying that's a lot of buying pressure after a sell climax? Probably the market is more likely to go sideways or even up than it is to go down. Bears want more information before they'll sell again, and therefore the trading range will probably grow to more bars. After about 20 bars, the bulls and bears become just about equally balanced. The market's neutral, and then it's in breakout mode. 50% of the time, the first breakout fails, like here. We have a triangle or a tight trading range. We have a bull breakout that fails. And ultimately, a breakout up or down, 50% chance it'll be up, 50% chance it'll be down. But after about 20, 30, 40 bars, the probability of trend resumption down becomes the same as the probability for trend reversal up. I talk all the time about the market cycle. The reason I do is because I trade each part of the cycle differently, so they each offer different trading opportunities. You can enter on pretty much any bar on any chart. A lot of websites make it sound like you have to wait for this perfect entry or this perfect trade. There is no perfect trade. There is no perfect entry. Institutions are trading on every bar. Every one of these bars has a lot of volume. And waiting for the perfect setup is nonsense. Waiting for a good setup is good, but the reality is institutions are buying and institutions are selling all day long on every bar, and the volume is big on every bar, on every chart. And the purpose of this course is to try to give you ways to get in. You know the market is going up or going down or going sideways, and you're trying to figure out how to get in. So I talk a lot, especially in the second half of the course, on how to trade. I talk a lot about how to get into the market, and then once you're in, how to manage. Markets always have scary stuff going on, like this and like that. And, you know, the market crashes every day. If this is a 1 minute chart or a 5 minute chart, it's a crash. If this was a monthly chart and you saw that, you say, yeah, that's a crash. Well, crashes are really common on smaller time frame charts, and they really do not mean anything. And a lot of times they're just legs inside of trading ranges. Every chart can be made of breakouts, channels, and trading ranges, and I trade each part differently. And it's important for me to look at a chart and be able to figure out what the market is doing right now. And that determines how I trade. So when I see this or this, am I buying? No, it's a strong bear breakout. I'm only going to sell. Only about 10% of the bars on a chart are in a strong breakout. And 90% of the bars on every chart are either in a trading range or in a channel. Here we got a bull breakout. I'm only interested in buying at that point. And then this is a trading range. In fact, the entire chart is a trading range. And once it's clearly in a trading range, I tend to switch to limit order trading, buying below bars and scalping, selling above bars and scalping. This is still a bull channel. We're getting higher lows and higher highs, but it's also in a trading range. I mentioned that A lot of times it's easier to make decisions if you structure the decision as a binary decision. Binary means two. You want to give yourself just two choices. So for example, you look at a part of the chart right here and you ask yourself, first off, is it a trend or a trading range? And if it's a trend, is it a channel or a breakout? So this is a bull trend and has pullback, so it's a channel. Is the channel tight or broad? And we're getting a reversal. Is it minor or major? Bull bars, but not great follow-through after bull bars. Where are the consecutive big bull trend bars? That makes this more likely a bull leg and what will end up as a trading range. There's disappointment after every bull bar, bear bar, trying to break out, disappointing, trying to break out, disappointing. And we have a lot of bear bars in this rally, closing on the low, decent-sized bodies closing on their lows. So this is probably a bull leg and what will end up as a trading range. Breakouts are followed by pullbacks almost immediately. Some of the pullbacks are lasting 4 or 5 bars. Bears are making money selling above bars. So sell above this bar, sell more higher, gets back to this point. They get out break even on their first entry and a profit on their second entry. So it's stair stepping up. Sell this high, sell more higher. It gets back to that first entry, buy break even at your first entry and with a profit on your second. A lot of bear bars, a lot of overlap, so it's a stair type channel. Limit order bears are making money. So this is probably a bull leg in what will soon become a trading range. So it's a bull channel, but probably not going to last much longer before it converts into a trading range. Because the trading range might be coming soon, a lot of the bulls will scalp. The bears are clearly scalping. They're selling new highs, selling more higher. Or instead of selling new highs, they simply sell higher and then buy back at the breakout point. This is a breakout right here. But is the entire thing a breakout or is it a tight channel? We have 2 bars in the pullback. It still could be part of the breakout, but then we get another pullback here. So I think this is a channel. Is it tight or broad? It's fairly tight. Pullback just 1 bar, pullback just a couple bars. I only want to buy. Look at this low, look at that high. The gap is open. Look at this low, look at that high. Gap is open. So we're still getting open gaps and pullbacks only a couple bars. So a tight bull channel. If you draw a line below and a line above, the lines are both fairly close together. So tight bull channel. It's a breakout on a higher time frame. I'm only looking to buy. Same thing with this bear trend. Bear trend, lower lows, lower highs. And the pullbacks, 1 bar, 1 bar, 3 bars, 3 bars. And the channel, if I were to draw lines, it would be fairly tight. Yes, we're overlapping. It's stair stepping down and bulls are making money. So they buy this low and try to scalp out. But the channel is very tight. In general, when it's tight like this, I'd rather only be selling, and usually I try to sell about halfway up. So here's a bear leg. When it gets around halfway up, I sell. If you cannot tell if the channel is broad or tight, assume that it's tight and only trade in the direction of the trend. So bear trend, you only want to sell. Reversals. We have a couple legs down and we are reversing up. Is this a major or minor reversal? Is it going to be a major reversal into a bull trend or a minor reversal into a bear flag or a trading range? In general, when the channel down is very tight, any reversal is probably minor, which means a bull leg in a trading range or a bull leg in a bear channel. So if you're buying a minor reversal in a bear trend, it's better only to be scalping. So a strong bull breakout, I only want to look to buy. And I can scalp or swing, and I buy for any reason. I buy bull closes, I buy at the market, I buy above bars, I buy above this bar, I buy below bars, below that bar, betting that the bear reversal will fail. And then the market converted into a fairly broad bear channel. This sell-off is strong enough, so some traders would say it's always in short. This sell-off lasted 15, 20 bars. It's a broad bull channel, and when it's a broad bull channel, it's bull, it's a type of bull trend, so you certainly want to be looking to buy. But because the pullbacks are deep, you can also sell. You can either sell the high and scale in higher, or sell at least a scalp distance above that high, looking for the market to pull back to that high, and then you scalp out. Bears are making money selling in a bull trend, and that usually means that the trend is going to evolve into a trading range fairly soon. Trading range, big up, big down, big confusion, so sideways. Traders will try to buy in the bottom third, sell in the top third. Bulls will buy down here. Bears will buy down here as well. So they sell near the top and they buy near the bottom. They sell near the top, and if it goes low enough, they buy. So bears sell near the top, and then they buy back their shorts at the bottom. Bulls look to buy near the bottom, and they sell out of their longs near the top. So both bulls and bears are selling high. Both bulls and bears believe the market is not going to go very far up or down, so they take quick profits. When a trading range is this tight and the bars are this small, there's no profit potential, not even with limit orders. And I think traders should not trade in a very tight range like that. In this video, I talked more about pullbacks, and then I talked about definitions within a trading range, legs, swings, pullbacks. And finally, I talked about trying to create binary decisions when you're deciding how to trade. It's good to be able to quickly decide, is it a breakout? I only want to buy. Is it a tight channel, tight bull channel? I only want to buy. Is it a tight bear channel? I only want to sell. Is it a broad channel? I can buy and sell. Or is it a trading range? I can buy and sell. This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the third of 3 videos on the market cycle. This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the first of 3 videos on always in trading. Every market is always in a trend or a trading range. And if there is a trend, there's an always in direction. If you had to be in the market at any one moment, it's better to be in the direction of the trend. I'm also going to talk a little bit about the trader's equation, the mathematical basis for taking and managing trades. Now, on any time frame, on any chart, any market, the market is either in a trend or in a trading range. After the market has been in a trend, it then enters a trading range. After it's been in a trading range, it then enters a trend, and the trend can be up or down. Remember, markets have inertia, and they tend to continue what they've been doing, and that's the basis of trading. 80% of reversals fail, for example, here, and 80% of breakout attempts in trading ranges fail. So, therefore, 80% of the bars on the chart continue to do what the market has been doing. Just look to the left to get an idea of what the bars off the screen on the right will look like. In a trend, the market's constantly trying to reverse, and 80% of the reversals will fail. So you should only trade in the direction of the trend. If you had to be in the market this entire time, in other words, if you were always in the market, it's an easy choice. You should only be short. And you can enter at any time. You could sell at the market, you could sell pullbacks, you could sell bear closes, you could sell bull closes. But if you're an always in trader, you have to be in the market, and you have 2 choices, long or short. When the market's clearly in a tight bear channel, it's a strong bear trend, you should only be short. Now look at this. We have trends up, we have trends down. This is a trading range. And 80% of attempts to break into a trend fail. You have to be trading in the opposite direction of an attempted trend. So if you always have to be in the market, you want to be buying near the bottom and selling near the top. And you just reverse multiple times. Sometimes when a trading range is forming, you're not sure that it's a trading range. Here we went down, but then we went up, and then we went down again. So the market's confusing. And that's one of the hallmarks of a trading range. If you look at a chart and you're confused as to what the market is doing, you should assume it's in the early stages of a trading range. On the other hand, if the market just keeps going up and up and up and up, and you start waiting for a pullback, you're probably in a trend. For example, here we have an 8-bar bull microchannel. Every bar has a low at or above the low of the prior bar. So it's a microchannel, no pullbacks. And if you're watching this and you're thinking, oh my gosh, I want to buy, but I want to pull back. So if you're thinking that you want to buy, but you want to pull back, then you know the market's in a trend. And therefore, if you're an always in trader, you have to always be in the market. You just buy at any time, even buying right here, because chances are the first reversal down will be minor. You can buy more, expecting the market to come back up here. You get out break even on your first entry and with a profit on your second. So you have to buy, at least small, because chances are, even if you buy this tick, the market's still going to go higher. And you can buy at the market. A lot of traders want to buy pullbacks, but when there are no pullbacks and you're waiting for a pullback, you're missing a great trend. So you just buy at the market, or if you're looking for some systematic way to trade, you just wait for a bull close and buy a bull close. Always in direction. If I have to be in the market all day long, long or short, The direction in which I'm currently trading is the always in direction. So when I see this, the market's going down. If I have to be long or short, I want to be short if it's going down. The choice usually is pretty clear, and you can almost always make a choice. The more the market is sideways, the more difficult the choice is, but you can almost always make a choice. Most reversal attempts fail. We got a bear trend, and we have a pretty good bull reversal bar. But does that look strong enough to reverse this? Probably not. Well, this is probably going to be a bull leg and a bear flag, which it was, and we went lower. And then here, we got a micro double bottom, a high 2 buy, so 2 legs down, 1 pullback 2, and then a second entry buy, and a fairly strong rally. And we broke above this high, but this is a minor high. That means that this is probably a bull leg in a trading range. It might be the start of a bull trend, but the bulls really need to get above a major high, the top of the bear breakout. Is this always in long at this point? It might be. So some traders would buy that close. Other traders would say, well, we broke out, but I want to see one more bar. This might simply be about a 50% pullback in this bear trend. And it might be a double top bear flag, slightly higher high, double top bear flag. So what does the next bar look like, the follow-through bar? Until we get one more bar or get above this high, a lot of traders will still think this is always in short. I would not be at all uncomfortable getting out of shorts. I would probably get out of shorts here and then wait. And I think maybe you could buy closes here, buy closes here. But if you do, you really need that one more bar. And if you get a bear bar and the market trades below the bear bar, you have to get short again because the bulls really have not done enough to convince everyone that they have taken control. And look at this. So you got that bull breakout bar. Let's say you bought the worst price, this close, and then you see this. What's your thought? You're thinking, darn, I knew I should have waited one more bar. This is really disappointing, this bear bar. And what do you do if you bought that close? Well, you're probably going to place a limit order to get out break even. And then look at this bar. It hit your limit order, did not get above it, did not get above this close, and you did not get out. And then this bar closed down. Then what are you going to do? You're going to say, uh-oh, I'm in trouble. I bought the high, a lower high in a bear trend. I tried to get out. I could not get out. If this starts to turn down, I got to get out. And that's what happened here. The bears sell again, either below here, a micro double top. You can call it a wedge, 1, 2, 3. You can call it a double top bear flag with a micro double top. Doesn't matter. The bears have to get short below a bear bar, either below this bar or below this bar. And here, the bulls gave up. We have a pair of bear bars closing below their midpoints. The bears have to get short again, and this is what they get short here. Ultimately, this looks like a bear leg in what will become a trading range. But if you always have to be in the market and you get out of shorts here, you have to get short again here. And if you get long here, you got to get out of your long there or here, and you got to get short. A lot of times you'll see the market looking like this. At this point, we're still always in short. But somewhere in here, you're starting to wonder, are we still short? And if you're not really certain, then you're in a trading range. And trading ranges always have both bottoms and tops. Here we got a double bottom, higher low, major trend reversal. Here we have a double top bear flag. In general, I always look to the left. What was the last always in direction? It was short. So if I did not want to be reversing constantly in here, it's okay to reverse constantly. But if I did not want to, I would stay short, stop still up here, and then wait for a breakout. If we get a bull breakout, then I'll get out. When not clear, and if you feel like you have to stay in the market, it's better to stay in the direction of what came before. Remember, when a pullback is less than 20 bars, it's a pullback and the trend will probably go down. When it gets more than 20 bars, it gets close to 50-50. In general, it's still slightly higher probability of trend resumption. So bear trend, trading range, trend resumption. So if I'm choosing, until I get a very clear buy setup, maybe this is clear, maybe that's clear, I don't know. Until there's a very clear buy setup, I'm going to stay short. If I have to be staying in the market the whole time, I want to look to the left and find out the last time the market was clear, and I'll stay in that direction. When you're in here, the last clarity was here. So we're probably still always in short. We had minor reversal attempts, but nothing clear, nothing clearly bullish yet. And what happened ultimately? Well, we got trend resumption down. Now, I said earlier, it's easier to make money if you trade in the always in direction. When the market's doing this, are you selling? The gap between this low, between this high and this low, slight overlap here, the gap between this high and that low. The bears are not making money. And the bulls, no matter where they bought, and for any reason, they are making money. Which do you want to be, a bull or a bear? You obviously, if you have to be in the market, and the market looks like this, you can only be long. it's much easier to make money trading in the always in long direction. Lots of ways to get long. You can buy pullbacks, breakouts of pullbacks. You can buy bear closes, betting that the bear reversal will fail. You can buy below bars, betting that the bear reversal will fail. You can buy for any reason, buy at the market. Again, always in short, easier to make money as a bear. Look for sell setups. A bull breakout of a bear micro channel, usually it's going lower. A double top bear flag or a wedge bear flag going lower. Double top bear flag, double top pullback, so a type of a triangle. It's better to focus on taking the sell signals rather than the buy signals. Now, a swing trade means that traders are looking for a reward that is at least twice as big as their risk. So if the current move looks like it's likely to reach 2 times the risk, it's a swing. The market's always in short, probably somewhere in here. Maybe this is a bull flag. Maybe there was a bull trend here, and this was a bull flag. Then we got a bear breakout and bear follow through. So at this point, the market's always in short, which means the first reversal up probably will be sold, and there probably will be at least one more leg down. So at this point, there is clarity. Traders know the market's probably going at least a little bit lower. We got a bear breakout and a follow through bar. So traders will either sell this close, big bear breakout, consecutive bear bars, or they'll sell that close. Betting that, what's more likely? We're going to reverse up or continue down. It's more likely we're going down. Probability favors the bears. Much easier to make money selling than buying. If you sell here, where's your stop? You could put it all the way up here. But if the trend is strong, it should not even get above this bar. So above that bar, above this bar. So putting a stop above the bear breakout bar or the top of the 2-bar breakout is also okay, because if this is a strong bear trend, it should not get there. And your profit target, you could argue based upon the height of the upper range, measured move down, where you're selling already at that place. Another way to do the profit target is a measured move based upon the height of the bear breakout. So the open of the first bar to the close of this bar, maybe the close of that bar, and then look for a measured move down. This is your initial risk. That's your entry price. This is 1 times your risk. You can see some traders bought there. And this is 2 times your risk. And you can see a lot of traders bought there. I think it's very important to always know where your stop has to be. And if unclear, put it way down, the start of the bull leg, maybe the start of the entire bull trend here. But we have a bull breakout here, and then we have a pullback. If I'm buying here, we may pull back for a couple more legs down. So I don't want to put my stop below there. I would put my stop below this bear bar here, below the bottom of this bull breakout. If I buy here and my risk is down to here, 1 time risk is somewhere up there. It's a high probability trade. I'll talk about the math in a little while. High probability trade, you can exit with a reward equals 1 times risk. So this is your risk, and the reward is the same as the risk. And when the probability is high, the math is okay to exit at 1 times risk. In general, if you're swing trading, it's better to be trying to go for as much profit as possible. So 2 times risk is better. Do you think it's a short here? Do you think it's a short here? Do you think it's a short here? No, it's still always in long. So swing traders are still holding long. Trader's equation is a mathematical formula that traders use. At least they think in these terms when they take a trade. Is the trade worth taking? I have an entire video on the trader's equation. It incorporates 3 variables: risk, reward, and probability. So if I buy here and I put my stop here, that's my risk. If I'm trying to get out here, that's my reward. And pretty strong trend. Is the probability 50-50 that I'm going up here before I get here? Or is the probability higher than 50-50? It's higher than 50-50. So if I enter here, what's the probability of going up 0.1% before going down 0.1%? 0.8% up versus 0.8% down. 10 ticks up, 10 ticks down. 20 pips up, 20 pips down. I'm looking at the same distance up as down. Pick any distance. What's the likelihood the market is going to go up that distance before it goes down that distance? In a trend like this, it's more likely to go up. I want to trade in the direction of the higher probability. So wherever my risk is, I want to reward at least that big, knowing that the probability is that I'll make a profit. And if you do the math, when you see this, you know 60% chance it's going there before it goes here. And if you do the math, if you win 60% of the time, risking this much for that much reward, you're going to have a profitable trading system. Here, always in long, always in short. Who knows? Maybe always in long. It's not clear at all. You wait for a breakout. And if you get a single bar like this, closing above the high of the past 20, 30, 40 bars, and closing far above the high of these bars, chances are this one bar alone is enough to make the market always in long. In other words, this one bar alone is so unusual that you have bulls who missed the trade. They're hoping for any pullback to buy. And you have bears who sold and sold more higher, and now they believe they're going to lose money. They're hoping for any pullback so they can exit with a smaller loss. Sometimes a single bull bar can make the market always in long. Sometimes it takes 2 or 3 small bars. Sometimes it takes 4, 5, or 6 very small bars to make traders believe that the market is clearly always in long. At this point, the market has a 60% chance of going higher, probably up for a measured move. A reversal attempt like this, more likely buyers below that bar than sellers, and that we're going higher. Now, I said one big bull bar. Sometimes you get 2 medium-sized bars, and that can make you believe the market's always in long. So at this point, you think it's always in long? Maybe you need one more bar. Well, you got it. Now you got the 2 biggest bars on the screen, both having bull bodies, both closing on their highs, and this bar closing above the high of the past 20 or 30 bars, far above the high of the past 20 or 30 bars. So if you buy here and your stop is here, what's more likely, that it's going to come down here or go up for that same distance? It's more likely it's going to go up. The market is clearly always in long. Even if you get a deep pullback, odds are it's going higher. And you did get a deep pullback. Now you got a triangle, 3 pushes down, 1, 2, 3, but you have another good bull bar here and another good bull bar here. To me, the odds are it's going up, probably for a measured move. I showed the last chart with 1 big bull trend bar. Here I got 2 medium bull trend bars, and that was all that was required for traders to believe it's always in long. Sometimes you get this instead, 3, 4, 5 consecutive bull bars. It's a single big bull bar on a higher time frame chart, but sometimes this is what you get. When you get this somewhere after the 4th, 5th, or 6th bull bar, you say, yeah, I think it's always in long, and I think it's going higher. So somewhere in here, traders are beginning to buy closes, betting that we're going to go up for some kind of a measured move. Reversal. At this point, you want to be long or short. Is this enough to make it short? No, we got a bear bar and then a bull bar. A bear bar, and the bears need at least 1 more bar. So chances are this is simply a 50% pullback from the strong rally and a breakout test of this breakout point. Even with this, we're still always in long, and the odds are we're going higher. Always in short, the exact opposite. Sometimes when you get a really big bear bar like this, that's all you need for traders to conclude the market's always in short. The biggest bar on the screen, it's a bear bar. It's closing below all of the prior bars, and it's closing far below them. If you sell here and you put a stop up here, what's more likely, that it'll hit your stop or fall for a measured move? More likely it's going to go down, right? You have scale and bulls who bought the low, and they see this and they say, yikes, that's terrible. I got to get out. And if it bounces a little bit, I'm going to sell out of my longs and take a loss. You have bears who say, wow, I was not expecting that. I missed the short. I'm going to sell any little pullback and betting that we're going down. Sometimes a single big bear bar like that is all that's necessary to make traders believe the market's going down. Other times, you get a bear bar, not big enough to make traders believe always in short, and then you get a second bear bar. So sometimes a pair of consecutive bear bars will be enough for traders to conclude the market's going lower. So at this point, we're always in short, which means you believe the market is more likely to go down than to go up. Traders see this. The bears who are not yet short look for any rally to sell. They'll sell above this bar, they'll sell below that bar, they'll sell below this bar. And the bulls who are scaling in all the way down and buying this low, buying that low, now conclude that it's probably a measuring gap and going lower. So they're going to use any little bounce to sell out of their longs. Bulls and bears selling, probably second leg down. Sometimes you get 1 big bear bar, but not enough to make you believe it's always in short, and not a great follow-through bar. But then you get 3, 4 bear bars, sometimes 5 or 6 bear bars. At some point in here, you conclude the market's probably going lower. Probably this bar. We broke below the trading range. We have 4 consecutive bear bars, 3 closing on their lows. At this point, you want to buy or sell. What's more likely, that we're going down the height of this range or going up to the top of that breakout? It's more likely that we are going down. When you look at this chart, what's the single dominant feature? Is it this bear doji? Is it this bear doji? Of course not. It's this big bull breakout. Right now, even though we appear to be in a trading range, the dominant feature of the chart is this very strong reversal up. And the odds are, even though we're 20 bars into a trading range, the odds are we're going to resume up. So I always look for something that looks outstanding or exceptional or very unusual. This is very unusual. Unless the bears do something pretty dramatic to reverse that, I'm going to assume that these are just bear legs and a bull flag. Bear bar, bad follow through. Small bear bar, bad follow through. Bear bar, bad follow through. Bear bar, bull body. Tails below bars. To me, this looks like a bear leg in a trading range, and probably it's simply a big bull flag. So I'm only looking to buy. In this video, I talked about how charts are always either in a trend or in a trading range. And I talked about the importance of the always in direction. If I have to be in the market at any time, do I want to be long or short? What's the direction that more likely will lead to a profit? Finally, I talked a little bit about the trader's equation. The math has to be good. Pay attention to the risk, the reward, and the probability when I make the decision to take a trade and make decisions on managing the trade. This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the first of 3 videos on always in trading.